I am Devlin Steele, Director of Education at Augusta Precious Metals, and this is a Touchpoint Update. As always, remember to like this video and subscribe for future updates. Things move fast in the economy, and what we're about to share with you is more important than ever. How do you stay informed, and how do you recognize warning signals? One way people try to keep up is by checking economic indicators like Consumer Price Index, or CPI. The CPI is the official government inflation meter, which measures how much the same number of dollars will buy in different months. Many economists and analysts feel that CPI is not a true measure of inflation and that true inflation is actually much higher. However, CPI can still give us a good indication of where inflation is according to the Federal Reserve and government. I warned people in 2007. What was the Federal Reserve Chairman Bernanke's warning then? Chairman Bernanke said, subprime mortgage woes won't seriously hurt economy. That wasn't a great warning, as we all know what happened in 2008 with the housing bubble pop and the subsequent market crash. So what is the Federal Reserve saying today? Current Federal Chairman Powell and ex-Federal Chairman Yellen agree valuations in the market may be high, but aren't worried about stability. It feels like Groundhog Day. No warning, everything is great. My question is, why aren't they worried about stability? I am. Any of you who went through the crazy hyperinflation of the 1970s are probably even more nervous and having deja vu. As Bloomberg reports, prices of materials used by U.S. businesses rise most since 1974. I remember very clearly that people had the wool pulled over their eyes back then. Many of you likely remember that inflation caused shocking price increases and that our savings suffered. There's no way to get around inflation's natural cycle, so the fact that we're seeing inflation again is no big surprise. Let's take a look at what the indicators are showing us today. The Wall Street Journal reports about inflation and CPI. U.S. inflation is highest in 13 years as prices surge 5%. Another metric we use to gauge inflation rates is the Producer Price Index, or PPI. With all the inflation that we've been seeing lately, it's no surprise that the PPI has seen dramatic increases as well. As CNBC reports, producer prices climbed 6.6% in May on an annual basis, largest 12-month increase on record. You can read about these indicators in the news as they happen. However, I have a source that I respect more. My cohorts from Harvard are all trained in data, and they work for global companies you know. They tell me from the front lines that there are supply chain and labor problems around the world. In their opinion, inflation is not temporary and we are just at the start. I can tell you that I value their opinions and insights more than newscasters, Federal Reserve, and government talking heads. In terms of actual money that this costs retirees, the numbers are shocking. This is true even if inflation is low, because seniors are more likely than younger consumers to spend money on things that rise faster than the CPI inflation numbers, such as healthcare. These effects are why people need more money during retirement than they thought to buy the same things that they can buy today. Here's a calculation from Smart Asset. This represents someone who saved $500,000 for retirement. If inflation was a steady 3% before retirement, when this person retires, Smart Asset says they would need $900,000 during retirement to buy the same things they can buy today for $500,000. Which brings us back to the indicators. The latest reported change in CPI was just shy of 5% from May 2020 to May 2021. This CPI change, in effect, is the inflation rate. It's startling to learn how much a steady 5% inflation rate would shrink your retirement savings. This is something that we can explain to you in depth in our web conferences. Believe it or not, 5% is actually considered low inflation. So imagine the effect high inflation could have on your retirement savings. But all is not lost. Gold and silver tend to have an inverse relationship with the dollar. As inflation hits and the dollar gets weaker, gold and silver tend to rise, maintaining at a minimum relative purchasing power. And what that means is the value of gold could buy the same goods and services 10, 20, 30, 40, 50 years ago that the value of gold can buy today, and in most cases, more. This is true at any time, but especially during times of financial stress caused by factors like inflation and hyperinflation. One great example is 1970 to 1980. That's when we saw those crazy inflation numbers that I mentioned earlier. With all the economic stress of that decade, gold increased 1,500%, which is impressive enough, but silver shot through the roof at 2,100%. Let's look at another example that's a little less extreme. From 2001 to 2011, during that decade, we saw a lot of economic and geopolitical stress, including a global war on terror. This chart is available on the Augusta Precious Metals website. You can see here that gold jumped 600% over that decade, but silver increased a whopping 950%. The point is that adding physical gold and silver to your retirement savings has the potential to offset losses that you might experience due to inflation and other financial stresses. Things are happening fast. Understanding what that means to your retirement account, what it means to you, and understanding what precious metals can do for a retirement account are now more important than ever. That's why so many people are signing up for our web conferences. If you're planning to retire in the next 20 years or are retired, find out about the warning signals. Learn in detail what's going on with inflation and how gold and silver play a role. Request our free guide. Meet with me and my team for our one-on-one web conference, and we look forward to meeting you soon. This is Devlin Steele, Augusta Precious Metals, signing out. If you enjoyed this content, make sure to subscribe to our channel and check back often for more updates.